colleagues, welcome back to the last session of this super conference on venture capital and private equity. My name is Niamh Moloney. I'm Professor of Financial Markets Law at the LSE Law School. So while I'm not a private equity or venture capital specialist, my subject, and indeed me, has been closely following the impact of the explosion in private equity on public markets. So it's been an absolutely fascinating discussion. Now this afternoon, as you know, we have a keynote by Professor Antoinette Schoar and two panels with distinguished experts. So fantastic way to finalise what's been a tremendous two-day event. Now, as you know already, just a gentle reminder, our event is being recorded, and a further reminder, as we all know, to please stay muted until you're speaking. So now for our first session this afternoon, it's really a huge pleasure to welcome Professor Antoinette Schoar from the MIT Sloan School of Management. And Professor Schoar, of course, is Professor of Entrepreneurial Finance and also Chair of the MIT Sloan Finance Department. Alongside, she's co-chair of the NBER Corporate Finance Group. Her research interests span from entrepreneurship and the financing of small businesses in emerging markets to household finance and intermediation in retail financial markets. And her many distinctions include the Brata Prize for the best paper in the Journal of Finance. Professor Schoar is giving our keynote address on the fantastic topic of the changing face of private equity, which I know we're all looking forward to very much, and will be speaking to us for about 35 to 40 minutes or so, after which we may have some time for questions. So Professor Schoar, on behalf of us all, the warmest of welcomes to our discussion. We're greatly looking forward to hearing your keynote, and I'll hand over to you.
Great. Thank you so much for your kind introduction. What I thought, I wanted to talk about a particular aspect of the changing face of venture capital private equity, and in particular, maybe posit from the beginning a somewhat controversial question, whether indeed we can even call private equity an asset class. Obviously, over the last 30 years, even maybe 40 years, private equity as an industry has grown tremendously, and of course, many asset management firms and large institutional investors, of course, treat it like an asset class and invest in it like an asset class. But, if you actually look at, and this is just some data to show you, right, indeed, that the industry really has grown tremendously. And even in the last couple of years in the pandemic, it has gone it has, in fact, not even, bat an eye or lost its stride, and grown quite significantly. Now, however, what I think a lot of research of many different people, including myself, has again and again shown is that private equity and venture capital in its statistical return properties look quite different from many other asset classes. In particular, say compared to mutual funds, or public stock and fixed income markets. And in particular, I would say three important pillars of public equity markets are in quotation marks violated in this industry. What I mean with this is the following. There is, number one, a lot of research that suggests that there is actually predictability in returns from the performance of one fund of the same general partnership to the next, which, right, in finance we would call this basically a violation of arbitrage freeness. And that's true even in the face of having very, very wide dispersion in performance between funds. In addition, right, we have also seen that the best performing funds in partnerships in VCP for a long time have not grown disproportionately, which is something that in other asset classes happens. So just, to in a way support these claims that I just made, right? I just want to remind you, there are a number of papers, for example, an early paper by myself and Steve Kaplan at the University of Chicago that first showed basically that there's tremendous dispersion in the performance of venture capital and private equity firms. So if we use either IRR or we use this measure of public market equivalent that basically benchmarks $1 put into a venture capital fund or private equity fund against holding that dollar just in a public benchmark, right? We basically showed in this paper that there is very wide, there's very large variation in return, much larger than in other asset classes. And, kind of this paper, obviously by now is an old paper, but, there have been many, studies that repeated these results. And so, for example, Preqin just, this year basically, repeated the same analysis and shows, for example, here, right, that the top quartile IRR versus the bottom quartile IRR indeed might have come down a little bit from the early time period, say the 90s and early 2000s that, Steve and I, for example, looked at. But you can see, right, there's still variation, and lately it has even gone up a bit again. And, you can see this when you eyeball the data, in addition, in particular, Steve Kaplan with a number of different co-authors have replicated these results and found that, they still hold. Similarly, Steve and I found in this earlier paper that there is not just wide dispersion, but also strong persistence of performance across funds of the same partnership. And of course, that is really surprising because it means there's a predictability of returns. And in some sense, right, there should be an ability of investors to differentiate the top from the bottom funds or the best performing funds. And of course, typically what we would expect is that money should then flow to these best performing funds. And, they should, number one, actually grow disproportionately. And second of all, when they are growing, right, given that especially in private equity and venture capital, it is very expensive to scale funds, right? Because the individual and underlying investments are relatively small, and you can't say instead of putting $10 million into a startup, you put suddenly $100 million into the same startup. That just doesn't work, right? So the scalability of the production function of investment isn't even that high. So, kind of that basically has been a real puzzle in the industry and also been a real puzzle for researchers. In fact, I've often been frustrated to hear people in industry saying to me, look, your paper shows that the top quartile funds always outperform. So it's just good enough that I get my money into the top quartile funds, and then I can sleep well at night. And I've always been quite concerned about this because, of course, this is an equilibrium outcome, right? So, kind of it's not somehow a fundamental constant. But I showed you this already. Basically, this just to say that if we repeat, kind of the analysis from the earlier paper that Steve and I did, even, kind of as of the last vintage, a study by Preqin and McKinsey shows that, persistence in private equity and venture capital is, again, has become somewhat smaller, but is still, very significant, especially at the top quarter. Yeah. Now, and as I already mentioned, kind of more recent papers have confirmed this. So, in a way that has to many people actually working in VCPE always been a puzzle. And really the puzzle is why would it be the case that general partners who seem to have, at least some of them, a ability to create these outsized returns, why would they actually leave money on the table for their limited partners? meaning leaving money on the table, either in terms of not increasing the size of their fund and with it then extracting more rents from the fund, or just maybe raising the fee structure itself and extracting more rent, right? Both of it for a long time, actually people and academics in particular working in venture capital private equity just didn't find much evidence for this. And, you know, we've all been basically puzzled by it. Now, actually, basically the topic of today's talk then, however, is that it does seem that actually changes on the horizon, or in other words, to say this right, what I want to argue is that these old puzzles are disappearing. And you could say that from a perspective of an finance theory and, you know, what you would expect as a researcher in financial economics, maybe this is not surprising that ultimately the competition for talent actually indeed erodes some of these puzzles. As I will argue, for investors in this market, that's actually bad news. And in particular, I will lean on some of the findings from my paper with Josh Lerner and Mao and Zhang that looks at, you know, that we call investing outside the box, and that looks basically at the changing structure of private equity markets. In particular, I want to argue that what seems to be happening is, especially over the last decade, that the best private equity groups are now indeed are capitalizing on their reputation and probably their fundraising prowess. And as I will show you, it does look as if actually those name brand venture capital and private equity firms are now actually growing their funds, and they're growing them in quite interesting ways, as you will see, that puts particular onus on limited partners to be informed in this space. And I will come back basically how we might think about this from the perspective of bargaining between venture capitalists and their investors, and also what it means for more or less sophisticated limited partners in this space. So what do I mean with, you know, this changing structure? And in a way, you know, a lot of what I want to talk about is basically already in this picture. So the green line here is just the aggregate fundraising trend in the main funds, right, of private equity firms. So think of this as the Sequoia fund number 5, 6, 7, 8, or Kleiner Perkins, you know, fund 3, 4, 5, and so on. And of course, right, as many papers have shown, this has really grown significantly over the last 4 decades. There was a slight crash, if you want, post-2008, after the financial crisis, which affected in particular private equity funds, because it also affected basically leverage markets. Right, but has recovered, you know, without problems post 2008. And here, you know, the reason why my data only goes to 2017 is because I'm looking at fundraising in funds of partnerships, where I can already actually trace some of the performance in these funds. You'll see in a second where I'm going with this. However, and that's kind of what is really new, is we have seen at the same time that, yes, main funds have been growing, we also have actually seen that a number of alternative type of investment arrangement between limited partners and venture capitalists have become very important. And there are a myriad of different incarnations, if you want, of these alternative vehicles, from, you know, feeder funds and parallel funds, co-investment funds, and other type of bespoke arrangements. We classify them for ease of analysis and tracking them into two bins that we call either discretionary funds. So these are my blue bars here. And discretionary funds mean funds where the limited partners have some discretion. Think of them mainly, these are co-investment funds, where also the limited partners make some input in the selection, maybe even the due diligence of the underlying investments and portfolio firms. The red part, or the red bars, is what we call GP directed. So these are the type of investments, investment vehicles, where the GP makes all the due diligence and selection decisions and basically offers the LP an opportunity to invest or not, but there is no due diligence or further involvement of the limited partners. And the reason, we broke it out this way is because we thought that maybe, in the discretionary funds, the quality of the LP might become even more important if they are involved in due diligence. Which, to some extent you will see is also true in the data. Okay, so what is also important in these different alternative vehicles is actually that it allows the general partners to offer different bundles of investment opportunities to a different subset of their limited partners, right? So while famously in the main funds of most venture capital and private equity partnerships, all investors, all LPs get very similar terms. And of course, the fund itself invests in one set of investments and doesn't carve out different parts of the portfolio firms for one set of LPs versus another. That doesn't work in the main fund, but in these bespoke vehicles or alternative vehicles, that's very much possible. And in fact, I will argue and show you that this is exactly how they're used. So it gives a general partner the opportunity to invite different subsets of their limited partners into slightly different deals. And as you can maybe imagine, and in fact, I will show you, indeed, in this new arrangement and in this changing way of how investment opportunities are made available to limited partners, actually the nature of limited partners and their outside opportunities will start mattering a lot, as you will see. Okay, with this, this is just to show you that, even the press has caught on and very much made this a topic that lots of articles are now delving into. This idea that, the classic traditional view that there's a main fund, and as long as you are lucky or, work hard to get into the main funds of of high performance general partners, then you're all set. And what I will show you now, that really is not the case anymore. Why we are able to look at this type of changing phase of venture capital and private equity is because we have really quite unique data from State Street Bank that previously was not available. As many of you know, State Street is one of the largest custodians in the world for large institutional investors in particular. And they are also one of the largest custodians for the investments of their clients in VCPE. So through working with State Street, we have access to the portfolio investments of about 112 global LPs that have been investing in venture capital and private equity already since 1980. And then, of course, through the 2000s. We follow the data here, as I said, till mid-2017, because we want to have some real performance indication of the funds that we're looking at. We obviously have data until yesterday, if we wanted, right? But that's quite meaningless, because a fund that is of a vintage, of last year, it's very difficult for us to know whether they're doing well at all and how they're doing. Yeah. What is also nice in this data and in what we are able to look at is that there's a lot of heterogeneity in the limited partners, and therefore also a lot of heterogeneity in the type of funds and GPs that we can look at. So you should not be worried that this is somehow only, maybe the top quartile of funds and we can only trace the best performers. That's definitely not the case. Now, as I said, we focus on the difference between the main funds and the alternative vehicles that limited partners of certain GPs can invest in. And we classify these type of alternative vehicles into GP-directed alternative vehicles. So think of those as parallel vehicles that invest in quite similar securities as the main fund, and where the GP retains all the key decision-making powers. And then we also, the second classification is into discretionary funds. Those, as I said, is where the LPs have some input and some say into what investment vehicles are being, what portfolio companies are being invested. And so, think of the discretionary investments are mainly co-investment vehicles, where the LPs invest alongside with the general partners. Now, I want to show you basically three main pieces of results about this new and changing phase of VCPE investment. First, just kind of generally, right? We want to understand how are these alternative vehicles performing, and this is, in a very descriptive way. I just want to show you for my set of general partnerships, when I look at the main funds of these general partnerships, and here what I'm showing you is, say, public market equivalents against the Russell 3000. We have tried many different benchmarks, including the S&P 500, the Russell 2000, but the results are really unchanged. What you see is basically that if I look, say, at the median fund, the performance of the main funds and the discretionary and GP-directed vehicles look very similar, right? And if I look, basically, this is, at the median, say, if I look at the weighted average performance, meaning weighted by the size of the different vehicles, even here, we see that the performance between the main funds and then, say, the alternative vehicles is not significantly different. They are slightly different slightly higher for the GP-directed vehicles, but overall, they're really quite similar. And the same is true if I look at IRR, even though, of course, IRR is our less preferred metric of performance because it doesn't take into account, right, the size differences of the return. So, okay, now, however, right, what I really would like to understand is not just how the average discretionary vehicle performs compared to a main fund. I would like to understand relative to its own main fund, right? How does performance look? And this is exactly what I'm showing you here. So what you see is that if I compare the private market equivalent performance of alternative vehicles relative to the main fund of this particular alternative vehicle, right? What you see is that actually compared to their partnership average, if you want, right? Actually, the performance is slightly negative, whether I use weighted, in particular, if I use weighted average performance, if I just use average performance, right, it's basically zero, yeah? But this is already telling you, and the slide worse relative performance is really in the GP-directed alternative vehicles. So in other words, right, this is basically telling us that typically it's the more established and the better performing general partnership that seems to be raising alternative vehicles. Those alternative vehicles end up having performance that is in line with the rest of the market, as I showed you in the graph before, but this is slightly worse than the performance of the main funds of the funds that actually go out and raise alternative vehicles. Now, and this is actually where now, you know, in some sense, the main argument or the main finding of this whole project comes in, which is we want to understand, right, how do venture capital funds, I mean, how do GPs use these alternative vehicles when inviting different types or different parts of their LP base to invest in them. Here, right, what we do is I will show you two sets of analysis. One very simple one, just to show you that actually just there is heterogeneity in general between the quality of the alternative vehicle that an investor gets to invest in and the nature of that LP. So basically, the identity of the limited partners matter because, say, if you, in particular, say a fund of fund, which, you know, kind of we know has probably, you know, they typically don't have as much sway with general partners, and they don't have the same reputation that, say, some of the more established limited partners like foundations or endowments might have, or some of the large public pension funds, you actually see cross-sectional differences. So what do you see here, right? Basically, what all I'm showing you here is that how does the performance of different limited partners within the VCPE space compare relative to the main funds, right? And here, like, if you can either look at the weighted average or the average performance, what you see is that in particular, fund of funds perform very poorly, whether it's with discretionary or GP directed funds, you know, and then we find, say, you know, foundations and endowments perform in some sense neutral. Remember though, right, it's very important to understand this is relative to the performance of the main funds of the same entities that are offering the alternative vehicles. And, you know, for example, say endowments and foundation invest in some of the best main funds, and therefore, right, in a way, the hurdle for them is already higher when they're investing in alternative vehicles. Yeah. So this is basically just to show you there is indeed meaningful heterogeneity in the cross-section between different general partners and limited partners. But, you know, kind of the real crux or the real question that I want to get at, or, you know, I was setting out to get up from the beginning is whether there's matching and assortative matching, if you want, between limited partners and general partners. And what I'll show you now is actually, indeed, there is positive assortative matching between limited partners and general partners. And what I mean with this is actually that what I'll show you now is when we look at sorry, the returns that LPs achieve with the same general partner differs significantly with the type of the LP. So this is holding the quality of the general partners fixed. I will show you that there is actually, there are differences in the returns that different LPs achieve. And so this is obviously, you know, very different from, you know, what happens in the main funds of the same general partnerships. So, kind of to show you this in a simple, descriptive form, what we do here is we use the sample of all alternative vehicles. So the top line is all, and then I break it out by discretionary and GP-directed funds. And all I'm doing here is now sorting these vehicles into bins where we look at situations where a limited partner who is in the top 50% of the limited partner distribution invests with the top GP, meaning a general partnership that typically is in the top 50% of the GP distribution, right? And then say compare it, if you look at column 3, compare it to what are the returns that a bottom 50% limited partner gets with the same set of general partners. Right? So this is holding the GPs constant. I look at the return to the LPs, and look what you see, right? Is that the returns for top limited partners are higher than for quote-unquote bottom limited partners, even holding constant the GPs. And this is particularly strong actually for the discretionary vehicles. And we don't find the same strong differences actually for quote-unquote the worst general partners. And we conjecture that a lot of it might be that actually worst general partners or worst performing partnerships might not even have the liberty of differentiating between their top and bottom LPs, right? Or another to say is they might not have very high performance vehicles that they could offer the top LPs. In fact, what we also find is that if you just look at the amount of investments that are being made, right, we find that actually the bulk of the volume is in this column 1, meaning basically that top GPs are carving out their better performing or their best performing assets to offer them to top performing limited partners, while they are offering actually very few opportunities to worse performing LPs, or you could think of them as lower status LPs. And then similarly, we find that these column 2 and 4, meaning, different LP groups investing with bottom performing general partners, is particularly rare in this column 2. So basically top performing LPs normally don't seem to want to invest with kind of lower quality GPs, and so they don't get a chance, if you want, to offer these vehicles. Now, so you see, what this suggests basically is that what the industry seems to have more and more not just understood, but found ways now to differentiate between LPs that might have a lot of bargaining power and therefore expect higher outside or higher performance because they have better outside opportunities versus LPs that actually don't necessarily have great outside opportunities, because if they were not investing with the top GP, in an alternative vehicle, they might have to go and invest in the main fund of a worse general partnership, right? And might not achieve, therefore, very high returns. And so the last question that we then ask, and I think that's also important to understand, is this, kind of this type of assortative matching that I now, that we are documenting, is this a sign that investors are getting fooled, or is it rather, right, a sign that even, say, lower tier or LPs that have access to lower tier GPs are understanding that they're not getting the same great returns that, say, a top LP would get, but they're still happy to take it because it might match up or even be better than the rest of their portfolio. And so when I do this analysis, right, I actually find that, or it looks as if it's not a game where LPs are getting fooled. Why do I say this? So look at this analysis. What we do here is we are now looking at the performance of a given alternative vehicle in one of these 4 bins. Again, still the same sort that I showed you before. But now I'm using as the benchmark, I'm using the return on the past portfolio of the LP in question, right? So for example, what I'm doing is I'm looking, how does an alternative vehicle offered by a top LP compare to all the other investments that this particular LP had in the past? And look what you see, right? When we look at top LPs investing with top GPs, these alternative vehicles seem to outperform even the relatively high benchmark of the past performance of these top LPs. But interestingly, you see what we find here is, and by the way, this is not a mistake, it is indeed 0.8, it's just the decimals after are somewhat different. So what you see here is that when a lower 50% LP invests with the top GP, even though I showed you before that their return they get is smaller than in column 1, right, when a top LP invests with the top GP, but you see it still beats the bottom LPs benchmark themselves. And so it doesn't seem that they necessarily are expecting to get the same great returns that the top LP gets, right? But they understand that, at best them or on average, they might get the kind of returns that they get in the rest of their portfolio. And then you can see, kind of for the alternative vehicles being offered by worse GPs, here we see again that when, say, column 4, right, when lower tier LPs invest with GPs, and that's actually where the performance is slightly better, but not, slightly worse, but not horrible. But for the top LPs, that's obviously a bad idea. So let me stop here and just summarize. So what I wanted to show you in terms of the changing nature here is that we see over the last decade at least this proliferation of a myriad of these alternative vehicles in many different forms, but that has allowed general partnerships to tailor the returns that they offer to LPs based on the past performance and maybe the sophistication of these LPs. And I write here, it further reduces the diversification opportunities. What I mean with this is that basically it really reduces the amount to which LPs can just lucky by, say, investing with Sequoia or Axel or Kleiner Perkins, right? What is happening is that if you are a no-name LP, even if you get to invest with Sequoia or Axel and so on, the type of funds that seem to be offered to them actually have lower returns. And so, this means indeed it heightens the risk of adverse selection for unsophisticated investors. And again, right, it places increased demands on the sophistication of the LP investment team itself. I didn't have so much time to show you this, but this again is especially true when we look at these discretionary alternative vehicles, where the LP team indeed, right, makes due diligence decisions alongside with the GP team. And so these are exactly the situation where the quality of the LP investors matters. And just, kind of to sum up, from the perspective of say, finance theory, this should not be a surprise, right? Because if really the scarce human capital here is the quality of top general partners, it's not surprising that then, right, this scarce human capital is trying to extract most of the rents and will not leave a lot of money on the table for, say, uninformed or unsophisticated investors to get that alpha, right? But of course, it just reminds us again how important it therefore is to understand that in my mind at least, venture capital and private equity really are not a typical asset class where, as long as you are well diversified and you make sure that you have relatively, kind of well incentivized intermediaries, you should roughly be okay, right? Given everything that I just showed you, this is clearly an asset class or a set of investment opportunities where it matters tremendously with whom you invest, which type of funds you have access to, and ultimately who yourself as an LP are, because that seems to explain a lot of the return that LPs experience in this market. Great. Thank you very much.
Professor Schoar, thank you. That was absolutely fascinating. I mean, I always worry about retail markets and retail market intermediation. So just yet one more thing to worry about after that fantastically rich presentation. Thank you. Colleagues, Professor Schoar is very kindly going to take some questions. So I have Simon, please. Great to hear from you. Thank you, please.
Hi, thank you very much, Professor, for that excellent presentation. I really enjoyed it. One quick question, actually two questions, if I may. First of all, I think that the evidence I've seen suggests that there's a difference between the performance of European versus US buyout funds. And I just wondered if you could explain to what extent your data picks up differences between different geographies, if at all, whether or not your data is all US or whether you can cut it by geography. And my second question is to what extent this is a story about fees. I mean, obviously, most funds, many funds, large buyout funds offer early bird discounts. So an investor that's willing to commit early, which is probably investors that are more perennial investors who have invested with that fund before, will usually get a discount to the fees. There's also discounts for volume. So if you commit larger sums, which again might be the investors that are more focused on the asset class, you tend to get, or you might get a discount of fees. This is all fully disclosed, known to everybody, of course. But done on certainly in Europe, it has to be disclosed to everyone under regulation. So it's everybody's understanding that the situation is, but there is a clear advantage to those who come into a fund at first close, or those that commit more money. And also in some of these parallel vehicles, there are different cost bases. So it costs more to run a Luxembourg sleeve because there's more European regulation than it does, for example, to run the main fund. So I wondered to what extent you think that some of these differences can be explained by those things.
Yeah, thank you. These are great questions. So to your first question, so we do see the location of the fund and also of the alternative vehicle. In fact, we find that at least as of, say, 2020 or 2017, really, initially, this was mainly a US phenomenon, and it was also predominantly a private equity, not so much a VC phenomenon. But we saw, some of the largest European private equity funds did use alternative vehicles, of course, too, but it's much more ubiquitous in the US. We found actually, interestingly, that early on in Europe, the alternative vehicles performed better than the ones in the US. But, the problem is that, of course, because there were so much fewer and they were so much more selective, right? It's not clear how to make of it. I should say, though, that in our analysis, we only have, kind of in terms of the the LPs that, kind of we looked at, we used mainly American-based LPs because we wanted to have, some comparability on this. But yeah, so I would say, kind of that's at least the most I can say about the geographic differences. In terms of, so I think your question about fees is really important. So in the analysis I showed you so far, these are, net returns, so after fees. And now, of course, and I only have basically these net returns. I don't know the fees for each of the investment vehicles because so far we didn't get them. We are hoping and we are in the process of collecting them. So, which you're right, could either mean that the fees are more onerous on some of the alternative vehicles, or the assets that are basically offered to the investors differ. What we try to do, and that's kind of a second best, given that we don't know the actual before fee returns. What we looked at, for example, is, how similar do the assets look like of the different investment vehicles. So, kind of imagine if we saw that the alternative vehicles invest in very similar investments as a main fund, or the alternative vehicle that is offered to a top LP versus a bottom GP is actually bottom LP is very similar in terms of its assets, and then we still see big net of fee differences, you would say that smells like fee differences, right? But interestingly, we found that the asset composition of the alternative vehicles that are offered to top versus bottom LPs by the same GP look very different. So that still doesn't rule out that the fees could also be different, right? But it at least suggests that it's not just that they make you, offer you the same kind of composition of assets and just charge their less preferred LPs more. So it seems really more a story of segregation of the assets as well. And in some sense, to me, that's also interesting because which is not something right now we know much about, right, is how well can actually the GP predict that certain of their assets are not going to perform so well as others, right? So understanding, that dynamic better would be great. Thank you for those questions.
Thank you. Thanks so much, Professor Schoar. I'm going to bundle two questions here together. So I have, I think, Alperen and then Professor Bartlett. Alperen, do you want to come in now?
Yes, thank you. My question was about policy implications of what you talked about. So in recent years, we have seen these investment flows to private capital, especially in search of higher yields, and pension funds, for example, flow to private equity, and especially it looked like a good thing because pension funds has long-term liabilities, so illiquidity did not really affect them. So we also try to encourage them. And as also their beneficiaries, retail investors, there's now discussion in the US and also in Europe whether we should open up the private markets to these investors. But from what I understood from your discussion, it doesn't seem like a good idea because the ecosystem you described doesn't seem to be suitable for retail investors to invest themselves or via pension fund. So I was wondering your thoughts on that.
Great, thank you. And Professor Bartlett, I'll just bring you in and we'll roll these together. Thank you.
Sure, thank you. That was a super interesting presentation. And I was just curious to hear more on what you're seeing in the venture capital context. had always viewed this as more of a phenomenon in the PE context, in part because the investment constraint isn't as binding. And what I mean by that is, if you're doing a Series A round, the company only needs so much money. And so to the extent that VCs offer opportunities to sidecar funds or to these direct investments, then you have to cut back the main fund, which obviously creates a conflict with the main fund's LPs versus the other LPs. And so, it's always struck me as more complicated, both from a fiduciary conflict perspective, but also just from sort of the economics of the GP. They're going to lose carry on that investment. So are you seeing it in the growth context of VC? Or are you seeing it in sort of earlier stages? Just invite your response.
Great, thanks so much. So, Professor Schoar, we'll close this session with your comments on the policy issue and the VC. Thanks so much, both of you. They're cracking questions to finish on. Thank you.
Thank you. Thank you very much. Yes, very briefly to Adrian's question, I agree with your sentiment that this seems like an asset class or a type of investment that's maybe not a fantastic fit with retail investors. It's just, the human capital needed to make these type of decisions, it just seems a mismatch, kind of with private equity and venture capital. But you ask, more generally, the policy implications from this, it's also true. We should keep in mind, right? These are very illiquid investments. These are very difficult investments to make. I wouldn't want to say that, therefore we need to now regulate somehow, what pension funds can even invest in these asset class. I think where we, especially in the US, are still lacking behind, I feel, is that the disclosure of fees and the standardization of fee disclosure, right, is we are still not there. And it's a bit sad because, I think transparency is something we should all embrace. And I think regulators from any political party and so on should be able to at least agree on that. And so I think, basically, I feel transparency would help here too. And my hope is a little bit that, transparency would all then make it easier to even monitor the investment officers of pension funds and other, big institutional investors to get a sense of, are they, it's slowly starting to happen, but are they even doing a good job in monitoring the fees in the funds that they're investing in and things like that, right? But definitely agreed that that doesn't seem to be the field where retail investors should play. Now, to Professor Bartlett's question, I think your sentiment is totally right. I mean, where we see is, for the very big VC fund families like, the Sequoias and the Accels and so on of this world that have even, lots of parallel funds in, focused on different industry classes, kind of where we actually see more of this happening. And we also, kind of from talking to a number of LPs, it is definitely true that in the discretionary vehicle side, many of the top LPs are pushing actually venture capital funds to give them opportunities to invest alongside in the hope of developing these investment skills for their own investment team. And so it is indeed in VC particularly focused on the very large and very established fund families.
Professor Schoar, thank you. I mean, that was the most really tremendous start to the afternoon. I think you cut across so much there, from policy to regulation, to that deep dive into this asset class and how it's behaving. I've learned a huge amount. I powerfully agree with you on this issue about fees. It's a huge question for how we think about policy in this area. So can I really warmly thank you on behalf of everybody for our final session. This was the most superb start. Thank you so much. That was absolutely tremendous. And I know I speak for everybody on the call. Thank you. So we're now moving on to our